Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to Live Squawk's Market Talk. And today we're going to be looking at yesterday's event, the big market moving event, Liberation Day, or Make America Wealthy Again, as the White House likes to term it. To help us really through everything that we saw yesterday, I'm joined by the Curve advisor, Joseph Choi. If you don't know who he is, get onto Substack, have a look and read of his pieces that are free to air, because I think you'll be the wiser for it. And we're also joined by Sam Cutler, portfolio manager at 333 Capital, and a guest we've had on before as well, and someone it's great to have back on another episode. Before we get into the reads on what happened yesterday, I'd like to just do a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to invite my two guests. Hello there.
Hey, Harry. Hey, Joe.
Oh, hey, guys. Good to be on.
Thank you very much. Well, where do we begin after yesterday's tumultuous day for the markets, really? Well, I say tumultuous day for the markets. A lot of the information happened after market close. The cash market closed for the US market. So we had to wait, really, until today for the reaction in the markets itself. But we did get aftermarket trading for the indices and some of the bigger stocks. So there was some immediate reaction, and obviously the currencies saw that immediacy as well. So looking at what we did see yesterday, for those who have been living under a rock, President Trump, speaking from the Rose Garden, laid out his plans for making America wealthy again, or as he said, as he terms it, Liberation Day, and imposed tariffs on near enough everyone, even trading partners as well as non-trading partners, and basically gave a blanket 10% baseline tariff on a number of countries, but then upped that for certain countries who he thought were more, I guess, pernicious in their taxation, as the administration sees it, in their taxation of US goods. It's all very unfair, according to Trump and his colleagues, and he wants to try and redress that. He also wants to try and bring manufacturing of goods back into the US, and he hopes this is one way of forcing companies, I guess, in one sense, to reallocate or relocate back to the US if they aren't there, or open manufacturing sites and produce goods from within US borders. We'll go through some of what we saw in a timeline, but he spoke at 4 p.m. Eastern time yesterday, April the 2nd, I think purposely after the markets closed, in order not to create disruption. And I think there was a rambling about 10, 15 minutes before he got into the reads and got into what he was trying to say, and brought out the charts that we'll show you. We'll take a look at the charts now. Sam, I'll start with you. How did you prepare? How are you prepped for yesterday's event?
Yeah, so I mean, as far as prep, I mean, I really had no expectations of anything. The communication from Trump, the White House, his whole cabinet has been, very unclear on this. It did surpass my worst baseline case. I mean, I thought at the very worst, we were going to get 20-25%, blanket tariff across all countries, and then they go and kind of negotiate them down from there. Really was not expecting some of these numbers to come through like they did. You take China for a prime example. It's now, that 34% on top of the 20, it's what, 54% now tariff on China. So these were just some astronomically large numbers. And I think you kind of saw the market react to that, right? You had that kind of, I don't want to say false headline, but the misleading headline come out from the Wall Street Journal on the universal 10% tariff, right? Which would have been, fairly reasonable, nothing crazy. And you saw kind of risk assets appreciate on that.
On the better side of expectations.
On the much better side of expectations. I was like, oh, wow, like that's surprising, right? So maybe the market was right in not kind of hyping up vol into this event too much, because it turned out to really not be that bad. But little did we know then the little pamphlet that you're showing there came out and started to really take these markets down. And I think the interesting thing here is it's just the way they calculated this. Like basically all they did was take the country's trade deficit, divide it by the US imports, and then divide that number by 2. And that's what they decided to charge all these other countries, right? And if you aggregate this whole number, I mean, it's going to take, I did the rough math really quick. It's going to take the average effective tariff rate, I think up to about 22% from that kind of, I think it's right around 2.3% right now. So it's an astronomical jump. And I don't quote me on the exact date, but I don't think we've had tariff rates like this since, I believe it was like the 1930s or something along that time.
I heard something similar. Listen, what you saw, yes, and there's been loads of arguments across social media today about the calculations. I think there was, and I'll bring up the guy when I remember him, who was arguing the case that this math doesn't work, and he actually had the deputy trade secretary on the wires just going, well, he does, and this is our calculation, and it was poo-pooed pretty quick and shot down pretty quickly. So it's an interpretation, I guess.
Yeah, and I think that kind of tells us a little bit about the stance. And I don't want to necessarily say the seriousness of all this, but I mean, like, these are going to be scaled back. It's part of a negotiation. This is the highest possible thing. Now come to the table and talk to me, and we can negotiate it down, right? So personally, I'm expecting a lot of this to get rolled back. I'll be very curious to see what actually gets implemented on April 9th. And I think a lot more could get implemented than I think on April 9th, because I don't think they could necessarily be as quick to resolve this, but I think they're going to have to. Everyone's going to come to the table and resolve this. Because I mean, these tariffs would absolutely nuke GDP. I mean, a little bit of rough math. Over the next year or two, these tariffs alone would lower US GDP growth by about 2.4% and has the ability to boost inflation by 1.5%, I believe was something I read, according to a Fed model from 2018. Okay. So like that's pretty big, right? And I still think the inflation impacts from tariffs, they are, I hate to say the word, but they're transitory. I don't think they're very lasting. And I think we can also see that in the way inflation markets are behaving, right? If you look at a 1-year inflation swap, it's skyrocketed, right? It's at 3.48% right now. But that's also because that 1-year coupon swap it emphasizes a lot of short-term expectations. And we've seen that through the soft data, right? The consumers are very worried about inflation. Inflation expectations are rising. But if we look at the market-based inflation expectations, they've been much more anchored, like the 1-year inflation swap, which will strip out a lot of that short-term inflation expectation, is still pretty well anchored at about 2.3%, 2.38%. So I still think the market does see these tariffs, if they do get implemented, as ultimately transitory because of the effect that it has on growth. And it is going to be kind of one-off price level impacts that, yes, it could boost core PCE over the next year, but it's not going to have any long-term effects. But that could also, play a role on what the Fed does. If inflation expectations are rising, I don't foresee the Fed, possibly hiking rates, but it could lead them to, just push these cuts out the curve out to 2026.
Well, it's going to be interesting. I mean, we had Cutler on last night in the immediate aftermath. Just wanting to be a bit more circumspect, but just laying out all potential avenues for policy. I want to bring in Joe. Joe, as a rates trader, and someone looks at the curve as well. What's your opinion of what you saw last night? Just that initial reaction, I guess, in the markets, and what you see.
Oh, so I wrote back in February that Trump's going to want to set tariffs high enough to zero out the trade balance with each country. And I think that's what you basically see on that table that you have listed up. So someone had worked out that that first column with Trump's data was basically, just a function of the trade balance. So I guess the key point is that he obviously believes, or is appearing to believe for negotiation purposes, that trade deficit should be zero, and he's going to use the trade deficit as a basis for negotiating. The fact that he said he was already being lenient indicates to me that he's unlikely going to move off of his number without some meaningful concessions. So the trade, so he wants the trade gap to be closed more or less. And this can be done through the purchase of U.S. goods or services, investments in the U.S., maybe some kind of financial transaction like the Mar-a-Lago Accord, or some investment in the U.S. I'm sorry, or some kind of a strategic investment in lieu of the trade deficit narrowing. And it's not even clear to me that he's going to try and negotiate for some kind of reparations for previous years. But basically, just kind of as as someone with an MBA and someone used to looking at negotiations.
Sure.
I really, for all these reasons, I don't know that he's going to come off of these numbers that much without getting something meaningful in return. So I think the markets got head faked a little bit because, the previous couple of times he was very lenient in terms of letting the tariff go without having gotten anything or gotten anything meaningful. But I think this whole time he had just been stalling for some tariff rationale that was going to stick. And so I think, I think he feels like these are going to stick. And so that's why I just tend to think that we are going to be in for a long tariff road ahead. So now, one of the interesting things I thought he did was he softened the blow to the economy by implementing the tariffs 10% at a time. And so I think there was some concern that doing the entire thing at once would cause something to break. And so this gradual approach where he cranks up the tariffs 10% at a time could help the economy adjust better, because it's hard for something to break on a 10% increase in prices. I mean, I'm kind of hard pressed to think what's going to break, like in that price range. However, this does mean that price increases may go on for months, so it's not clear how transitory the price increases are going to appear to be. And so, so we have this whole dynamic of, what the Fed's going to think about these constantly ratcheting up of prices, and what the consumer is going to think about these constant, ratcheting of prices.
Well, like you say, that leads to the expectations issue that we already saw creeping up ahead of yesterday's event, I guess.
Right, and that's not going to get any better,
No.
or for at least the next couple of months or a few months. So I guess what I'm most curious about is the reaction of the countries to, to this tariff announcement, because some countries like Australia, who was hit by the 10% tariff level, said there would be no retaliation, and I think for the 10%ers, I don't think it makes sense to get crazy with retaliation because that 10% could easily get negotiated much lower at some point by offering to make some purchases or investments or whatever. So what I'm really curious about is how the countries with the 25% tariffs are going to approach the negotiations because, as we saw earlier, Trump gets very trigger happy if someone retaliates. And so, I think the Australians calmed the markets down a little overnight, but we could be off to the races again if there's escalation with a major trade partner. And both China and Canada, vowed to retaliate, and the EU seems to be taking a slower approach.
Well, I just want to break in there because the interesting part of this, 40% of Canadian exports are already USMCA compliant, and this could potentially double, according to numbers there from National Bank of Canada today, in following the completion of compliance recognition processes. All right, so and if I'm just looking at that list there as well, we'll come back to Canada and Mexico, the nearest neighbors, but Brazil, doesn't the US run a surplus with Brazil? So, a lot of this anger towards these nations, foul anger, if you like, is not even warranted when you're running a surplus against some of these nations as well. And I'm sorry, but if you think Cambodia is going to help, things are going to change. If it was a level playing ground, you're going to get a lot from Cambodia. I don't get that. But again, I understand the 10% baseline because you wanted to stop people circumventing the tariffs and the impositions on the larger percentage nations that he's taxed. So I do get it. But just widening out, then going back to Canada and Mexico, for example, where's the biggest issue? Okay, look at the economies. The European Union clearly, if it wants to get serious, could create a problem for the US. As could, I've heard today, I know this was said before, but Trump's actions could potentially bring non-friendly nations like Japan, China, and South Korea together to bring a uniform response to the imposition of tariffs and trade duties. I mean, it's extraordinary what you're seeing in that sense. So, where do you see the biggest issues in terms of and the biggest danger zones, Sam?
Well, I think it's very fair to see that that if if we don't make deals, it's very easy for the EU to come in and attack U.S. tech, right? That's got to be number one candidate for them. Again, I refer back to what happened last time when, what was it? The tariff rate on Chinese exports rose, I believe it was 20-something%, right?
Yeah.
And that's thank US GDP. So yes, you have these exemptions, for Canada and Mexico. That's fantastic. But then if we're importing from China now with a 54% tariff rate, 20% tariff rate on the EU, and Volkswagen just came out with a release this morning that they're raising the prices by 25%. So these costs are going to be passed down to the consumer. Right. So I just don't see the logical thinking here. It's obvious that they've made it clear they want to, lower the 10-year rate. How do you do that? You kill growth. Right. So I'm just kind of game theory out what kind of Trump is thinking in this. And the only conclusion that I can come to is he's looking at this to pull growth down, kind of hurt the economy, say, hey, this is the economy we inherited from Joe Biden. Now he's going to come in the second half of the year with, let's not forget about the other side of his policies, which is deregulation, tax cuts, try to kind of soothe the market and start to pick things back up. And then before midterms, he said, hey, look at the economy I inherited, look at what the market did, look at what I came in with policies, and we covered it. I think that's possibly how he's thinking about this, but there's still a lot of risks to that, right? Like if we do get supply chain disruptions, and you can kind of see some of this with recent PMI surveys, right? We're slowing new orders, rising input prices, margins are getting squeezed, and these are kind of supporting stagflation scenarios, which would obviously be the worst outcome for the US, right? So I kind of try to look at this and break it down to three scenarios, right? Either we get a mild tariff scenario where they negotiate tariffs down, right? And that will, again, we'll get back to that inflation moving lower, and Fed can kind of align with market expectations. If we start to see a stagflation and these tariffs persist, so they take much longer to get negotiated back down, inflation could easily jump 1% into the end of the year from here. And that would severely weaken growth. We could still probably avoid a recession, but that would kind of push the Fed to maybe hold rates flat for the rest of 25. And then we'd obviously see how 2026 would evolve. Or you get the complete polar opposite, where you get, a complete bond bear market where inflation surges, growth holds relatively strong, which I have a hard time seeing, because you start seeing all these employment metrics start to slipping. So it's whether is the hard data going to start catching up with the soft data, and NFP tomorrow will give us a little bit of a sign, but we can talk about that a little bit later. But then one thing you also have to think about here on top of the tariffs is, as the dollar weakens, that only makes import prices higher.
Yeah.
So it's just, there's so many moving parts here. And I think all of this put together, I think yesterday was really, really terrible. And I'm having a really hard time finding anything positive there. And I will agree that I still don't think equity, Mike, if this does come to fruition, equity markets are still not pricing in a full effect of this.
That's a very good point. Let's look at this from the market perspective then, because we can try and set game theory President Trump and his administration, but I think we'd have headaches at the end of it. So again, Joe, how would you play this as an active market participant? What are you doing at the moment? What's your philosophy generally in order to guard getting hit and hurt by whipsawing markets and everything else?
Yeah, so I guess, one of the themes I've been talking about in my newsletter is I'm just wondering if Trump couldn't have handled his foreign relations better, because, the whole bit with Ukraine, Greenland, Panama, Venezuela has the world alarmed. And the U.S. is probably hated by most of the world right now. So you hear about boycotts of U.S. travel, boycott of U.S. products like Tesla and bourbon, and even selling of U.S. assets. Like earlier in the month, the Dutch pension fund sold Tesla. So, the tail risk I see is that a lot of these things don't come back even after a deal is reached. And this is probably for at least the next 3 years while Trump's in office. And there's a chance that it never comes back, depending on who's elected after Trump. So now that the tariffs are not just threatened, but enacted on many countries, we can see, we can look for signs of follow through by foreigners, because the amount of financial foreign investments in the U.S. is on the order of so I may not have heard correctly, but I thought it was on the order of tens of trillions of dollars in recent years.
Yeah.
And, so part of this equity meltdown today might just be, part of that unwinding, because countries aren't really going to want to support a country that, has been as belligerent as we have under Trump. So that's the big tail risk I see. A minor tail risk I also see is we could actually get some supply chain disruptions from the whole customs and tariff process, because it's not clear to me if we have the manpower, especially with the Doge layoffs, to actually process the tariffs on, like from most of the major countries in the world. And
that is a fear for sure.
Yeah, and these tariffs are going to be changing probably every month, and so I guess what I've been doing is just looking at just the tail risks, because right now it's really hard to take a strong view on how this is going to play out, but I did think the tail risks were underpriced.
Okay, interesting. Sam, from your perspective, portfolio manager, you juggle a lot of balls in the air. How do you face this at the moment? How do you guard against this? How do you protect yourself in the best possible way?
So from a personal standpoint here, I can speak as we run a lot of thematic equity baskets on top of some currency trading and rates trading. Leading into this, I was pretty neutral on a delta basis, just because I really had no expectation of the market, right? I really had no idea what was going to come. So I figured the best thing would be hands off. I owned a little bit of downside gamma in the S&P. I owned a little bit of gamma in yen, just in case we started to get a little bit of a safe haven bid. So those were able, luckily, to protect some of our equity holdings. But from here on out, I kind of just want to be delta neutral. So essentially, I will be short S&Ps against my equity positions on a portfolio delta neutral basis. So I can just kind of mitigate the downside, as I think we're going to kind of bleed down. Okay. But as a portfolio manager, I can't sit here and move in and out of all of these equity baskets every time Trump says something, right? So I have to kind of formulate my ideas of how I think the next 3 quarters, the next year is going to play out from this front, and kind of try to manage the little fluctuations or squiggles in between here.
Right.
That's kind of how I'm approaching things right now. I'm in a very wait and see mode. One thing I find very interesting here is the way gold reacted to this, right? Gold came off $100 an ounce off the highs on this, which I found pretty interesting. Then I start to think, okay, well, how are these other countries going to function, right? What if China devalues their currency?
Okay.
There's all these other, there's these other scenarios they can take to try to.
Drastic. I mean,
it'd be drastic, but to help dampen the effects of these tariffs. If Trump is as serious with he is, which it's like, is there a Trump put, right? He's serious about this because he's been talking about this forever. I think someone pointed out the other day, there was an article he wrote in 1987 talking down about NATO and how we need to tariff more and the US is losing its backbone. And this was in 1987.
Yeah.
So he's definitely had this agenda, right? And I think in his first term, he was a little more restricted with what he can do. Now in his second term, he's kind of aligned his cabinet and people around him that are going to kind of support his views a little more and let him run with this. So it's a fear of mine. I can't say like I have a really clean read on anything right now. I feel very comfortable. I have a very uncomfortable feeling about this.
But again, and you probably reflect a lot of the market at the moment. I think a lot of the whipsaw we may be seeing relates to just the short-term money in and out on an intraday basis. We did mention jobs report. I want to get onto that before we finish. I mean, I could go on for another hour about how this might damage the dollar's credibility, how, as Joe sort of touched upon, in terms of longer-term damage to the US's reputation and its standing as a global force. It's not going to be quick, but we've already, over the years, with diversification out of the dollar's been talked about more and more. Will this hasten that transition away from the dependency on the dollar? These are all questions now. I think we're at a very pivotal time in the global economy and, well, just generally the world as a whole anyway. But this is a very interesting time. I want to come a bit closer to home, a bit closer in time. Tomorrow we have non-farm payroll, 12:30 GMT, 8:30 Eastern time. Just to quickly look at that before we have to leave things. Consensus is around 138,000 after 151,000 last month. Bank of America Merrill Lynch predicted the US non-farm payroll was likely to increase by a robust 185,000. That's their estimate in March, higher than consensus, due to payback in leisure and hospitality for cold weather in Jan and Feb. Government job growth is expected to come in at just 10,000 due to the federal hiring freeze, DOGE. Given the muted claims data in the survey week, we do not expect DOGE-driven job cuts to be a sizable drag, although risks are to the downside, and we expect the U rate to remain at 4.1%. That's the unemployment rate at 4.1%. Just to quickly go through some of the other key components, I guess, of the report tomorrow as analysts look at it. We're looking at the, again, unemployment rate 4.1, which will keep it unchanged. The labour force participation seen at 62.4%, also unchanged. A quick look at average weekly earnings on the month over month. They're seen at 0.3% as was, and 4% for the year over year figure. Right, we'll start with you, Sam, on this one very quickly. Tomorrow's jobs, does it matter, tomorrow's jobs report, in everything we've seen this week in the backwash of what we've had yesterday?
I think it's going to be skewed, right? I think the market reaction function is going to definitely be skewed to NFP now because of what we saw yesterday and today. I think if we get a weak number, all hell's going to break loose, right? Because then that supports, okay, growth is getting destroyed, the labor market's cracking. And I think if we get a strong number, it doesn't really necessarily mean much against what happened, right? And I think, I'm kind of in line with some of these surveys. I think 180 to 200K seems very reasonable for tomorrow's number on a lot of give back, like payback from the cold weather effects that we had in January and February. You look at home-based data, the majority of sectors did show improved hiring. Education was the only negative sector, but it was still less than March of 24. The biggest gains were in entertainment, home repair, and hospitality. So I definitely think it's skewed to an upside surprise in payrolls tomorrow, but I don't think that's necessarily going to mean much on the back of what we've seen over the past day and a half now unfold.
Yeah, fair enough. And by the way, the graphic says Feb non-farm, but it's obviously March non-farm payrolls. So I'll correct that afterwards. Joe, any views on tomorrow's jobs number?
Well, as Sam mentioned, it's hard to interpret since we had all the weather effects earlier in the year, and it's not clear how much of that is going to bounce back. I don't think we'll get a clean read until next month. So the whisper on non-farm payrolls is 120,000, but most of the better economists who I think use the higher frequency data probably think we get a higher print, like Sam mentioned. So it's kind of rare that we get the whisper and the economists on opposite sides of the number. So it'll be interesting to see who's right. As for the unemployment rate, which is what I also focus on, it's a toss-up between the 4.1 consensus and the 4.2. So it shouldn't be that surprising if we get a 4.2. I guess the one thing I'm curious about is what the effect of immigration will be, because when we had a lot of immigration, some analysts claim that immigration was the reason for an upward bias in the unemployment rate. And now that we have restricted immigration and even started deporting, it'll be interesting to see what the effect is in coming months. We've also had the issue of some immigrants perhaps not wanting to participate in the surveys for fear of getting identified. So I do think the data will be interesting in that respect. But I agree with Sam in that I don't know that, an upside surprise is going to change the market tone that much, because the payrolls are backward looking, and these are, before tariffs were implemented, more or less. And so I think the markets are probably going to shrug it off. But but if we did get a very weak number, then, we're probably going to be off to the races again. So, and then one thing about tomorrow that I wanted to mention. So Powell is speaking tomorrow. So I'm actually curious to see if he has any, change of tone since, since the last FOMC meeting. So, so that could also be interesting. I mean, Powell is one of the more devilish members on the FOMC, but I'd be curious to see if he has any change of tone on whether it's the tariffs or the equity markets or, just so we can get a gauge of how far away the Powell put is, if there is one. And then we also had some additional poor UMISH data. And now that tariffs are here, it's not clear that the survey inflation expectations are going to get any better. I mean, if anything, they're probably going to keep getting worse. So I'm also curious just to see if he has a take on that.
So, I mean, there's enough to the end of this week. So, yeah, thank you, Joe. There's so really, I mean, the volatility isn't going to calm down, I think, into the end of the week, start of a new quarter as well. So obviously some new positioning to be done by some of the bigger houses, I guess. So it's going to be an interesting end to the week on the whole. Listen, guys, we need to wrap it up now, but I'd like to thank you very much. As I said, we could have done another hour on this quite easily. But we'll post this up in the near future. This is a recording, so we'll put this out later on Thursday, the 3rd of April. And you can listen back in your own time and obviously listen to the preview for tomorrow's non-farm payroll. Sam, thank you very much. Joe, thank you very much. You can, Sam, again, portfolio manager at 333 Capital, and Joseph Choi, writes the Curve Advisor and active trader as well. So have a look on Substack for his content. Thank you again, guys, and thank you everyone else for listening. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.